Okay, let's talk about it. It's the age-old question every investor faces. Do you bet on the high-energy world of stocks, or do you trust the timeless, steady value of gold? It seems like a simple choice, but it can shape your entire financial future. So today, we're pitting them against each other in the ultimate investment showdown.
All right, let's not waste any time. Let's just cut right to the chase. If we look at just the last 12 months, who came out on top? Was it the stock market's growth machine or was it good old-fashioned gold?
And the winner is gold. And honestly, it wasn't even close. Over the last year, from 2024 to 2025, gold delivered a massive 25% return. To put that in perspective, the Nifty 50, that's India's top 50 companies, only managed about 9 to 10%. So in the short-term sprint, gold wins by a mile. But, and this is the big but, is that the whole story?
Oh, not by a long shot. Because when it comes to investing, your timeline changes everything. That one-year snapshot, that's just one page in a much, much bigger book. To really get what's going on, we need to zoom out.
So why did gold have such a fantastic year? Well, it wasn't random. It was a classic case of gold playing its role as a safe haven. You see, when the world feels a bit shaky, with geopolitical tensions and economic uncertainty, investors get nervous. They pull their money out of riskier assets and run to something stable. And that something is very often gold, which pushes its price way up. But watch what happens when we zoom out to a full 10-year period. The whole picture flips. Over the last decade, the Nifty 50 actually inches ahead with an average annual return of 14%, just squeaking past gold's 13.2%. It's a much, much closer race. This shows you that over the long haul, that growth engine of the stock market really does have an edge. And performance never happens in a vacuum. It's always tied to what's happening in the world. Think back to 2020 and the COVID crisis. Gold was the star. Then in 2022 and 23, with war and soaring inflation, gold was the perfect defense. But during those quieter periods of just steady economic growth, that's when stocks tend to shine. So the winner really just depends on the economic weather report. So what's the right way to even think about this? Well, I find a sports analogy works perfectly here. Just imagine your investment portfolio is your team. You wouldn't build a soccer team with only strikers, right? And you definitely wouldn't build one with only defenders. To win, you absolutely need both. And here are your star players. The Nifty 50. That's your offense. It's your innovation engine, the part of your team that scores points by creating wealth through growth, new ideas, and company earnings. And then you have gold. Gold is your rock-solid defense. It's not going to score you a ton of points, but its job is to be an incredible store of value and protect your wealth when the other team is on the attack. Let's just be crystal clear on what we mean by defense. In the investing world, we call this a portfolio hedge. Basically, it's like insurance. When your other investments, like your stocks, are taking a hit during a crisis, a hedge, like gold, usually holds its ground or even goes up. It protects your overall buying power when you need it most. And this all leads us to the most important point of this entire conversation. It's not about choosing one over the other. It's about combining them into a single, powerful strategy. It's about building a team that can score goals when times are good and defend the net when the pressure's on. So what does this balanced team actually look like in practice? Well, for most people who are investing for the long term, financial experts usually suggest putting about 5 to 15% of your portfolio in gold. That gives you that crucial defensive protection without giving up too much of the amazing long-term growth you can get from stocks. Now, of course, that's not a one-size-fits-all magic number. It really depends on you, on how comfortable you are with risk. If you're an aggressive investor who's all about growth, you might keep your gold allocation under 5%. A balanced investor will land right in that 5 to 15% sweet spot. And if you're more conservative and focused on protecting what you have, you might go as high as 20%. All right, so we've looked at the short term, the long term, and the roles of both offense and defense. So what's the one big idea you should walk away with today? Well, looking forward, a lot of analysts are pointing to a really interesting historical pattern. It turns out that when the value of the Nifty 50 gets low compared to the price of gold, it has often been a sign that a big stock market rally is just around the corner. Now, history is never a guarantee, but it's a super compelling trend that gives us a hint about what might be coming up next. So let's sum it all up. The real debate isn't gold or stocks, it's gold and stocks. Your time horizon is everything. And just remember that simple analogy. Stocks are your offense, gold is your defense. And for most people, that strategic 5 to 15% allocation to gold is the key to building a portfolio that's ready for anything.
And that leaves us with one final, really important question. In a world that seems to get more uncertain by the day, it's worth taking a hard look at your own investments and asking yourself, is my team ready for the next game? Is my portfolio truly built to last?